Ever pondered the current financial market risks? Of course, it's a vast and complex arena, so let's break it down to make it more digestible. Firstly, consider the rise in credit card delinquencies over the past 12 years. This upward trend signals growing consumer financial stress. Analyst Anna Wong talks about credit score inflation, where lenders may overestimate borrowers' creditworthiness. This asymmetry could lead to tighter lending standards, potentially triggering a recessionary cycle. Then, we have the stock market risks. U.S. households hold a record-high equity exposure, concentrated among the top 10% and baby boomers. A market correction could severely impact affluent consumers, driving a negative wealth effect and reduced spending. Moreover, state tax revenues, heavily reliant on capital gains, are also at risk if markets decline. Let's not forget about shifts in consumer spending. High-end consumer confidence is declining, with wealthier individuals trading down to budget retailers, while lower-income groups reduce spending altogether. This trade-down effect reflects broader economic strain, exacerbated by inflation and stagnant wage growth. Now, think about housing market vulnerabilities. Housing affordability is worse than pre-2008 levels, with prices still elevated despite rising rates. If institutional investors holding large inventories sell, it could exacerbate price declines. Ivy Zelman even predicts potential 25% price corrections, though timing remains uncertain. Student loans and credit contagion also pose significant risks. The resumption of student loan repayments may push 10 million borrowers into delinquency, spilling over into credit cards, auto loans, and mortgages. This could create a domino effect of defaults and tighter credit conditions. Next, consider the macroeconomic risks and lag effects. Past fiscal stimulus delayed recession signals but is now waning. Liquidity-driven markets face reversal risks as government support diminishes. State and local spending cuts and reduced federal aid add to downward pressure. So, what's the market outlook for the upcoming earnings season? Expectations of disappointing earnings are on the rise, with negative growth likely as companies face margin pressures. Sectors like housing and retail are particularly vulnerable. And finally, let's talk about investment strategies and advice. The emphasis is on income generation and hard assets to navigate volatility. David's Substack, Haymaker, offers model portfolios and analysis, focusing on ETFs and income strategies while avoiding individual stock picks. He stresses the value of professional financial advisors to maintain discipline, manage complex assets, and avoid emotional decisions. In summary, understanding these key points of the current financial market risks can empower you to make informed decisions. From the rise in credit card delinquencies signaling consumer stress, stock market risks, shifts in consumer spending, housing market vulnerabilities, student loans and credit contagion, to macroeconomic risks and the market outlook, it's crucial to stay informed and vigilant. And remember, professional advice and disciplined investment strategies can help navigate these complex waters.